Spread betting markets are generally priced off futures markets because that's their natural hedging medium. The purchase and sale of assets in the future, as opposed to right now, depends upon the cost of carry and the yield you would have if the asset were held now rather than later. By which I mean that, take the long gilt. We could buy a long gilt for, say, price X now, or we could buy it as a futures contract in 1 year's time. Whether that would the asset be more or less expensive in 1 year's time, it depends upon the cost of whether it would be less expensive if you make a profit by holding it. So it would be preferential to buy it now, and it would be more expensive if you make a loss by holding it. And the loss is calculated by the cost of carry relative to the yield of the asset. Financial assets have a yield. When you buy them today, you get a yield from that asset. You bought it at X and you get a yield over time from it. Of course, you've had to spend money to buy it, so the success of your purchase depends upon the cost of the money you borrowed to buy it relative to the yield you get from it. If over time that's a running profit, then it obviously pays you to buy it now rather than in the future. Therefore, the same asset will cost less in the future than it will now. If, however, you make a running loss in purchasing, say, a long gilt or a US Treasury note, if it's a running loss, then it pays to forego the purchase and defer the purchase to the future, and that will naturally bid up futures prices relative to the current spot prices.